In this lesson, we will discuss the types of cost allocation methods for recording utilization of PP&E. As I mentioned, such as depreciation expense is the most common, which is on our income statement. In this slide, we take a look at a different topic, the PP&E valuation issues, the difference between GAAP and IFRS. Remember, that's International Financial Reporting Standards. IFRS actually allows a company to report its PP&E at book or fair value through what we call a revaluation process. Please note that if a company does choose this revaluation to fair value, all the assets within a class of PP&E must be revalued on a regular basis. Keep in mind, GAAP is more restrictive here. It requires PP&E to report on the balance sheet at book value only and prohibits revaluation. Remember the historical cost principle earlier in this course. This very topic of GAAP versus IFRS asset valuation was discussed back in the FASB interview we had with Brian McCune at the end of an earlier course module. The acquisition cost of the long-lived asset should be allocated to future periods of benefit as follows. So for PP&E, we call it depreciation expense, very commonly known. Next, we have natural resources, which translates into depletion expense. And finally, for intangible assets, we call it amortization expense. So there are basically three key factors in our cost allocation of our long-lived assets. First, we have our service life or useful life. It's basically the length of time that the asset will provide benefits to our company. Typically, though, it's less than the asset's physical life. Second, we have the allocation base, which is the value of the usefulness that is expected to be consumed by the asset. And our base is equal to the cost, historical cost, minus its residual or salvage value, which is basically the amount of money expected to be received at the end of the asset service life. And thirdly, our third factor is the allocation method, the pattern in which that usefulness is expected to be consumed. So the depreciation methods that we're going to review are as follows. There's activity-based, of which there's 1, units of production. And then there's time-based models, of which there's 3, the straight line or SL method. Then there's 2 accelerated methods. First is the sum of years digits, or SYD, and second, the double declining balance, or DDB method. So let's take a look at a cost allocation method example with the following data. You have a machine that costs you $250,000. The service or useful life is expected to be 5 years. And we think the residual value at the end of that 5 years is $40,000. We also think this machine will produce roughly 140,000 units throughout its life. Now, the actual units produced are also shown here at the bottom of the slide. If you add up those 5 years of amounts, you'll see that the total produced is only 130,000 units, which is less than the estimate we just discussed. So continuing on with this cost allocation method under the activity-based model, we have to figure out what the units of production depreciation expense are, which is calculated as cost minus salvage value divided by the estimated number of units produced. So in our example, it's 250 minus 40, 210,000, divided by 140,000 units, which gets us to $1.50 per unit. So in year 1, if I actually produce 24,000 units, multiplying that times $1.50 gives us an expense of $36,000. In year 2, we produced 36,000 units. Again, multiplying it times that same 150 gets us to $54,000 of expense. As you can see by this method, the annual depreciation expense is in direct correlation to its activity level. Perfect matching principle. Next, we talk about the straight line or SL depreciation expense method. Same concept, cost minus salvage values are numerator, same as before, divided by the asset useful life. So in this case, it's the 210,000 divided by the 5-year life, which gets us to 42,000 a year for each of the 5 years. Thus, as you can see, there's equal depreciation expense in each of these 5 years, which is 1/5 or 20% per year. Keep this percentage in mind, as we'll need this a little bit later when we talk about the DDB method. This method leads to a smoothing of expense and related income levels. Moving on to the sum of years digits or SYD depreciation method. Again, it's the cost minus salvage value, that same numerator we've seen before, times the n times n plus 1 divided by 2, which n is your number of years of useful life. So for example, in year 1, we take the 210,000 again, times 5/15. I got the denominator as follows. I took the 5 times 5 plus 1, which is 6, which is 30, divided by 2 is our base of 15. So as you can see, the depreciation is 70,000 year 1, 56,000 year 2. This is the real key of an accelerated method. It pushes out much more expense in those early years of the life of the asset. Next, we talk about the DDB, or the double declining balance method. This one's a little bit tougher to understand, a little bit more quirks to it. Here we just take the book value, we ignore the salvage value, and we multiply that times 2 times the straight line rate. Keep in mind, this is the only method that actually does ignore that salvage value calculation, as you simply use the beginning book value to calculate each year's expense. We remember from prior lessons, though, that book value is what? Cost minus accumulated depreciation. So here for year 1, we take the $250,000, the cost, not backing off the salvage value, times the 20% that we had in the straight line rate, times 2, which is 40%, and that's $100,000 of expense in our first year. In year 2, I take the $250,000 of cost, minus the $100,000 I had in year 1, gets me to a base of $150,000, times that same 40%, I now push out $60,000 of expense in year 2, much higher expense. As you can see, this accelerated method of DDB pushes out the highest expense of all in the early years, even more than our sum of the years digits. So let's kind of recap what we've done with this cost allocation method. The activity-based method provides actually the best match of all revenue expense because it's based on amount produced. The straight line method, simplest of all to calculate, actually smooths out our income and expense throughout the years. And basically the tax benefits derived from our accelerated methods are key in that more expense in those early years of the life of the asset means less taxes paid in the early years. Remember the time value money we talked about earlier in the course. Unlike inventory with its crazy LIFO conformity rule, it's actually okay to use different depreciation methods here for tax versus our book or financials. Stay tuned, as there'll be really a fun animation at the end of this week's lesson which will demonstrate this key difference between the accounting for inventory versus the property, plant, and equipment cost allocation. Let's take a look at some other cost allocation method issues. First, you have a group depreciation concept, which allows depreciation expense of similar assets collectively put together. An example might be a fleet of delivery vehicles, say for the United States Postal Service trucks. The key here is there's no gain or loss recognized when any of these similar assets are sold. For example, assume a delivery truck that cost $20,000 is now sold for $8,000 in 2018. The journal entry would be as follows. We would debit cash for $8,000, cash we brought in, debit the accumulated depreciation for $12,000, and credit the vehicles, the asset account, for the $20,000 we're taking off the books. Again, key point here is no gain or loss recognizes, only the accumulated depreciation is reduced by the difference. Our next issue we talk about is partial period depreciation. This is when the asset purchase occurs at times other than beginning or end of the year, which quite honestly is only found in textbooks. More commonly and more realistic is these assets are bought and sold throughout the year. Common convention used in most companies is what we call the half-year convention. It's a method that's used where half of the full year's depreciation expense is recorded both in the year of acquisition and also in the year of disposal. This simply eases the record keeping of your fixed asset register and your fixed asset department.